Hello everyone, in this video we will be doing the chapter 15 of ACCA F3, which is bank reconciliation. Before watching this video, make sure that you have checked the previous videos, and if you haven't, I have linked it in the description box below. You can check out the playlists. In case you would like to solve the Kaplan exam kit, I have linked the playlist for the same in the description again. So this is a very easy chapter. This is an easy chapter, but sometimes people find it hard. This is going to be a little bit different from what we have studied in the 12th grade, but if you've done that well, then this is going to be very easy for you. So what exactly is bank reconciliation? You know that if I am a customer, so we all have bank accounts, right? So I have a cash book. What is cash book? Cash book is basically myself recording all my transactions. And what is a passbook? You must have heard of the word passbook. Passbook is another word for bank statement. So what is bank statement? Bank statement is basically a statement which is provided by the bank where it shows all the transactions. We all know what bank statement really is, right? So I tell you, what is a cash book? We know what a cash book is. We make cash book. If I am making some pay, so what is the balance of cash? Cash balance is debit. So in case my cash is increasing, I will put it on the left side. In case my cash is decreasing, I will put it on the right side, right? So if I'm making a payment to someone, I will show it over here. If I'm receiving payment from someone, I will show it over here, right? That's how we used to do it. So whatever transactions I make, for example, I have received a check from someone. I'm receiving cash from someone. So I will basically put it here. If I am paying someone, if I'm giving my check to somebody, so cash is going out of my account, I will show it over here. So that is how I basically make the transactions. That is how I record my transactions. Now, thinking of the same examples, how does a passbook or how does a bank statement? Also, whenever I say passbook or whenever I say bank statement, I am referring to the same thing. Passbook and the bank statement is the same thing. They are just two different words for the same meaning. Now, taking into account the same example, if you think about it, how does a bank record in its passbook or a bank statement? So this is my bank statement. So bank statement is basically the banks who are making records of the transactions which are going on in my account, right? They are basically recording what is happening in my account. This is what I'm doing for my personal thing. I personally would like to keep a record of what is going out and what is coming in. But passbook, it is the duty of the bank to maintain the record, maintain the bank statement of every account which is with their bank. So what are we gonna do? For example, in my passbook, there is a balance, let's say 10,000. Okay? And I just gave a check to the bank, so money has been credited, so the passbook will add this much money to me. Example. So the idea of this chapter is that bank statement is something which is maintained by the bank for us, and the cash book is something which we are maintaining for ourselves. We are basically going to talk about what reconciliations are. Sometimes the balance of the passbook does not match with the balance of the cash book, which is weird, right? My bank account is maintained by the bank authorities. So my bank statement is maintained by them. I am maintaining a cash book, but eventually I am talking about the bank statement only. They're one and the same thing. So the balances of both has to always match, right? Sometimes what happens is that the balance does not match. That is why we need to figure out what the balance in my cash book is and what the balance of my bank is according to the bank. So what is the balance of the bank statement? And if they don't match, we are going to reconcile and check out where we made an error. What exactly did we do, which is the reason why we have this kind of discrepancy. Okay? Now you need to keep some things in your mind. Okay, before starting this, make sure that you have a notebook with you, a pen with you, and a calculator with you. You need to note down all the formulas and you need to solve the questions along with me while watching this video. Otherwise, there is no point of watching this video. Okay, now, so there can be mistakes. Usually, there can be mistakes due to which such situation occurs. For example, let's say, okay, let's say I take classes, whatever, and a person, a person paid me the fees. The person did not inform me that he is going to go and credit money into my bank account. He did not inform me. So he basically credited to my bank. So my initial balance was 10,000. He went and gave a check of 500. So he did not tell me that he was going to pay me through the bank. He did not inform me. So I did not know about this. So my total balance will be 10,500 in my passbook, in my bank statement, because the bank knows that I just received money. But I did not know that he was paying me. So in my cash book, I did not mention this 500 because I didn't know that such a thing happened, such a transaction happened. So my balance is going to be 10,000 only. But my actual balance is 10,500. So you see, there's a difference of 500. These are the kind of errors which will occur, right? So we need to basically create a reconciliation and we need to investigate and find out where we made an error and we need to rectify it and basically reconcile it, and we need to make sure that the cash book balance is equal to the bank statement balance. Okay, one thing you need to know, very easy. Okay, wait, I hope you write this down. This is very important, but it's easy. So we are doing bank reconciliation, chapter number 15. Okay. So when we are talking about cash book, what is the balance of cash book? No doubt, we know that the balance of cash book is debit. We've been doing this since forever. The balance of cash book is debit, which means if my cash increases, I debit it. If my cash goes out, I credit it. Right? This is very simple. And so you know that the balance of the cash book is debit, which means if there is an increase in cash, I debit it. If there is a decrease in cash, I credit it. Easy. When we are talking about bank reconciliation, when we are talking about passbook or when we are talking about bank statement, what is their balance? Think about it again. You don't need to get into the detail of it, but the bank statement's balance is always credit. Why is it credit? Because cash book we are maintaining, but bank statement is recorded from the perspective of the bank. So the balance is always going to be opposite because they are maintaining it from their perspective. So something which might be a loss for me might be their profit. If something is my income, that will basically go out from their bank, so that would be something negative for them. You get my point? So you just need to remember that the cash book balance is debit, no doubt we know that, and the passbook balance or the bank statement balance is always the opposite of the cash book, which is the credit balance. Okay, so my balance is credit. So if there is an increase in my bank statement, I will credit it. If there is a decrease, then I will debit it. Okay, this much keep it in your mind. Do not worry, do not get confused. We will be solving questions. Now let's talk a little bit about mistakes. What kind of mistakes can a person make? Let us see that. Before we go and read the theory in the book, let us see the kind of mistakes. Okay, if you are an accountant, it is your duty to every day download your bank statement and check and see what things you have missed in your cash book and what transactions you haven't recorded. So it is basically your duty that you need to download the bank statement every day and you need to check where you have made an error or where the balance isn't matching. Okay, so we need to keep one assumption in your mind, that usually all the mistakes are made in the cash book. Usually, all the mistakes are made in the cash book. Usually, we have just 3 exemptions for the same rule. We have 3 exemptions that we will look in the detail. Don't worry about that. But usually, when you think about it, bank usually doesn't really make mistakes, right? It's always us. We are not professionals, so we usually might make mistakes in our cash book. So we need to make an assumption that most of the time the mistake is made by us in our cash book. Okay? But there are 3 exemptions of the same. Let us first see what are the exemptions where it is not our mistake, it is the bank's mistake. Let us see them. Let us now see the exemptions, or let us see the mistakes where it is not our mistake. Okay. First of all, bank charges. This is the most important one, bank charges. Take a moment and try to think about what bank charges mean. Again, when I'm talking about bank charges, it is bank charges errors. So what does that mean? That means that bank has by mistake debited 10 rupees. Bank has by mistake cut 10 rupees from my account, but that was an error from the bank side. He shouldn't have done that. So that my fault? No, that is bank's fault, right? That is obviously bank's fault. Why did bank do that? It wasn't supposed to do that. Okay. What if the bank by mistake credits 1 lakh into my account, but it had to actually credit it to somebody else? That 1 lakh was to be put in somebody else's account. By mistake, bank put it in mine. Is that my fault? No. That is again the bank charges errors. That is the bank's mistake. So that is what we are talking about, the bank charge errors. Okay? No doubt in this. So this is something where it does not involve our mistake, right? Second one. Okay. What is the second thing which might have happened due to which there might be a difference in balance, but it is not our fault? Think about it for a second. Let us say I am X, okay? And Y is my supplier. I purchased good from Y. And I gave Y a check of $1,000. I gave Y a check of $1,000. Okay? So in my cash book, I will mention on the credit side that I have given a check to Y of 1,000 rupees. So I'm going to mention that 1,000 rupees has gone out of my bank, right? That's what I'll mention. But what did Y do? Y did not give the check in the bank. So when you receive a check, you need to go and give it to the bank. Only then the money will get credited to your account, right? But Y forgot to give the check in the bank. Or Y thought that he will give the check after a year. So until now, Y hasn't given the check in the bank. Now tell me something. But according to me, I have already given him the check. So in my cash book, I have mentioned that I've given him the money, but he did not give it to the bank yet, right? So whose fault is that? Is that my fault? According to me, I've given the check, I've given the rights of $1,000 of me. So this is something which is not our fault. This is known as unpresented checks. This is known as unpresented checks. What are unpresented checks? I have already given someone the check, but they haven't presented it yet. So that has nothing to do with me. It's not my fault, right? That is what is known as unpresented checks. So I hope you understood both of them so far. Bank errors and unpresented checks. Now, let's see the third one. The third one is basically lodgements unclaimed. Now, what is lodgements unclaimed? I am X, I do a business, and Y is my customer, and I sold goods to Y. So Y gave me a check of, again, let's say $1,000. Y gave me $1,000 check. I go to the bank that day and I give to the bank 1,000 check, and I tell the bank that put this in my account. So I go home, and in my cash book I show 1,000 on the debit side. Why? Because I received a check and I banked it, so it will come to my bank. I'm assuming that I've given the check, so I'll receive the money and I will do this. But then I check my account and I realize that $1,000 haven't been credited yet. So I call the bank and I ask them what happened. The bank says that um, they are going to do it. Right now, they are a bit busy. Within 3-4 days, it will get claimed. So I have lodged the check, but they haven't claimed it yet, right? So that is something which is known as lodgements unclaimed. This is again not my error, not my fault, right? I have given the check to the bank. It is the bank's error that the bank did not yet credit it to my account. So that is known as lodgements unclaimed. Take a moment and revise the entire thing. Okay, so you understood that there might be 3 things which will not be a mistake. The first one is the bank charge errors. The second one is the unpresented checks. What is unpresented checks? It is that I have issued the checks, I have given the checks, but they haven't presented in the bank, so that has nothing to do with me. And the third one is the lodgements unclaimed, which means I have received the check and I have banked it, but the bank hasn't credited it to my account. So this is also not my fault. Okay. Rest also, these are the mistakes which are not our mistakes. You remember what assumption we made? Usually all the mistakes are made in the cash book. Usually all the mistakes are made by me. So only these 3 exemptions which we've studied, only those can be the bank mistakes. Rest everything else is my mistake. Okay? Rest everything is a mistake in the cash book. Rest all mistakes in cash book. Okay, so now tell me something. If there is a mistake by the bank, then where should the changes be made? In the passbook, in the bank statement, or in the cash book? We are right, but the bank is wrong. The bank committed a mistake which we studied earlier. So then the changes will be made in the bank statement. If I have made a mistake, then there's an error in the cash book. I have made a mistake, so all the corrections will be made in my cash book and not in the bank statement. Okay, very simple. So if it's my mistake, I will edit in my cash book. If it is bank's mistake, they will edit it in the bank statement. I hope you have no doubt so far, whatever we have studied. Now, one more thing. Okay, so we know that the balance of cash book is debit and the balance of bank statement is credit. So whatever is increasing, so whenever I have something in debit in cash book, it's going to be plus, positive. Whenever I have credit in cash book, it is going to be negative, and in the bank statement, it is the opposite. Whenever I have credit, something is going to be positive, and whenever I'm going to debit something, it is going to be negative. Take a moment and revise the whole thing, then we'll start with the question. Okay. Always remember that in the bank statement, everything is recorded on the perspective of the bank statement. Okay? It's not going to be recorded from my perspective. Bank statement, whenever we are making a bank statement, we need to think of ourselves as the bank and record the transactions from their perspective. Now, let us start reading our theory and starting with the questions. The objective of a bank reconciliation is to reconcile the difference between the cash book balance. So, what is the cash book balance? It is the business record of their bank account. It is business or me. I am recording it. What is the bank statement balance? It is the bank record of the bank account. The bank is recording it. The cash book is the double entry record of cash and bank balances contained within the nominal ledger. In effect, it is the cash control account. Note that debits and credits are reversed in the bank statements because the bank will be recording the transaction from its point of view in accordance with the business entity concept. You know what the business entity is, right? The cash book records all transactions with the bank. The bank statement records all the bank's transactions with the business. The contents of the cash book should be exactly the same as the record provided by the bank in the form of a bank statement. Both the balances has to match eventually. That's what is the aim, right? And therefore the business records should correspond with the bank statement. This is in fact so, but with three important provisions. The ledger account maintained by the bank is the opposite way around to the cash book. I told you, we are recording from my perspective, but the bank is recording from his perspective. If I am receiving some money, they are giving the money, right? It goes out from their bank. Something like that. You need to keep in mind. This is because the bank will record transactions and balances from its own perspective. Therefore, if a client has a positive bank balance and the bank would display this as a credit balance because it has a liability to pay it back to the client. If the client has overdrawn, this would be shown as a debit balance because the bank is owed a repayment. Understood? Timing differences. So what is timing differences? We have discussed it. A check payment is recorded in the cash book when the check is dispatched. The bank only records a payment when it is paid by the bank, which may be several days later. This is the bank errors. This is the lodgements, unclaimed, and all of that. So we record it early, but it happens after a few days. So those kind of errors are the timing errors. Items such as interest may appear on the bank statements but are not recorded in the cash book as the business is unaware that such a transaction has occurred. The bank will deduct its interest charges and you won't even get to know. The existence of the bank statement provides an important check on the most vulnerable of an entity's assets, cash. However, the differences referred to above make it essential to reconcile the balance on the ledger account with that of the bank statement. The reconciliation is basically carried on a monthly basis usually. That's what happens in most of the companies. Okay. Now, we are going to discuss the differences between the bank and the cash book. So we have already discussed all this, but we are just revising it from the textbook so that you are aware that we've done it all. When attempting to reconcile the cash book with the bank statement, there are three differences between the cash book and bank statement. Unrecorded items, timing differences, and errors. So they are basically categorized these errors into three, categories. Okay. Unrecorded items. These are items which arise in the bank statements before they are recorded in the cash book. So what did I say? Everything else is our error. So it is my duty to download the bank statement and see what happened in the bank statement, and I need to match it with my cash book. Except those three exemptions which we saw, rest all are my mistakes. So interest. What is interest? The bank statement deducted interest from my bank account and I did not know about it. It is my fault. I should have downloaded my bank statement and seen that they have deducted and I had to make the same entry, but I didn't check. So it's my fault. Bank charges. Bank has charged me for something and it has deducted it from my bank statement, but I haven't shown it. But now I have downloaded it and I have seen, and I will now edit it. I will edit in my cash book. My fault again. Dishonored checks. Now, what is dishonored checks? Dishonored checks. We have done it in the previous chapters. And you might be thinking that this is not my fault. Why should I do this? This is usually not my fault. But it is your fault that you did not check your bank statement that such a thing occurred, and you should have basically reconciled it, but you didn't do that. So this is your fault. Always keep in mind, only 3 things can not be your fault: the lodgements unclaimed, the unpresented checks, and the banking errors. Rest all are going to be your mistake. So dishonored check is also your mistake. When you know that a check has been dishonored, you should have checked. You should have every night, as an accountant, you should have checked the bank statement and reconciled it. So now these are the things which are basically recorded in the bank statement, which means they haven't been recorded in the cash book. Why? Because we didn't know this happened. Then we open the bank statement and we check it, and then we reconcile with the cash book. Okay, let's do the test understanding 1. On which side of the cash book should the following unrecorded items be posted? So if something is increasing the cash, we will debit it. If something is decreasing the cash, we will credit it. Then we'll discuss. Okay, bank charges. What is bank charges? Is it my fault? Yeah, it is my fault. So the passbook has already entered it. So, but I haven't deducted it from my cash book, so I will credit my cash book because my cash is reducing. Direct debits are standing orders. What is direct debits or standing orders? That is basically, for example, if I have to do SIP in mutual funds or anything like that, I put a standing order that every month on 5th, let's say on 5th of every month, I want $1,000 to be deducted and put in my SIPs every month. So direct debits, I don't remember that I have set an alert, but the bank has, it is 5th of this month, the bank has deducted it, but I haven't shown it in my cash book yet. So basically now I will reduce the SIP amount, so which is basically credit. My cash is reducing, right? So if my cash is reducing, then I will credit it. Direct credits. So direct debits is when the bank reduces the money, and direct credits means the bank has credited amount. Now you might be wondering that debit means increasing the cash and credits means decreasing the cash. Yes, you are right. But we are talking about from the perspective of the bank. The bank has credited amount. So for the bank, credit is my debit. We saw that the balances are opposites. So direct debits, credits will increase my cash, so I will debit it. Dishonored checks received from customers. Dishonored checks received from customers. So some customer gave me a check, I gave it to the bank, and I have written in my cash book that I have received the amount, but the check has been dishonored, so money hasn't been credited. So I will now again reduce it from my cash book, so I will credit it. Bank interest received. Bank has given me interest. For example, if I have basically given some money in the bank, or if I have basically, kept my money in the fixed deposits, I receive interest for it. So bank has given me interest, but I haven't recorded in my cash book. So this will increase my cash. So I'm going to debit it. So I hope you know how to approach it from the perspective of the cash book. Now we'll be talking about something which is the timing differences. What is timing difference? These items have been recorded in the cash book, but due to the bank clearing process, they have not been recorded in the bank statement. So timing differences are basically outstanding or unpresented checks, or outstanding or uncleared lodgements. We have discussed both of them, right? Checks sent, okay, now what is outstanding checks or what is unpresented checks? They haven't presented it. Checks sent to suppliers but not cleared by the bank. Outstanding or uncleared lodgements, checks received by the business but not yet cleared by the bank. So that is something which we have already discussed. The bank statement needs to be adjusted. So rest all the mistakes will be adjusted in the cash book, but these three things will be adjusted in the bank statement, right? Now think about it carefully and try to understand this, because once we're done with this, we are done with the entire chapter. We'll just start with the questions. Balance as per bank statement. So if I have a credit statement of the bank statement, it will be positive. If I have a debit statement, then it will be negative. You can understand that now? Okay. We are recording in the bank statement from the perspective of the bank. Okay. Now think about it. Outstanding or unpresented checks. Someone hasn't basically given the money yet. Someone hasn't basically like it is. So we are supposed to receive the money, but the bank hasn't credited. Okay, wait a second. Okay, again, unpresented checks. What is unpresented checks? I have given someone the check, they haven't presented in the bank, but in my cash book I have shown that I have subtracted the money. So the bank should do the same, right? If I have subtracted the money, the bank missed to do this. It has to do that too, right? So outstanding or unpresented checks, the bank has also subtracted. Now let's talk about what outstanding or uncleared lodgement is. I've received the check, I've given it to the bank, I have added it in my cash book, or I have debited in my cash. I've showed it in the debit side of my cash book, but the bank hasn't shown that cash has been added to my account. So it is not my fault, it is the bank's fault, so the bank should add it. That is it. Only these things will be the bank's mistake, and then we'll have the new balance, which is the revised balance as per cash book. So how are we going to approach the questions is that we make a cash book, okay, and we make a debit side and a credit side. So here whatever have been my errors and whatever is increasing the cash will come here, and here whatever is my error but which has decreased the cash will come here, and you'll get a balance over here. Whatever the balance is, that should match with my bank reconciliation statement, and it should balance. We'll start it with the balance per bank statement, and end we come to the balance as per cash book. This balance should match with my cash book balance. Don't worry, we'll be solving the questions, it will become easy. Okay. Errors in the cash book. The business may make a mistake in their cash book. The cash book balance will need to be adjusted for these items. Errors in the bank statement. The bank may make a mistake. Example, record a transaction relating to a different person within our business's bank statement. The bank statement balance will be needed to adjust. So we know this. We know that this is the third thing. Bank errors was also one of the exception. So that will also be the bank's mistake. Okay. Outstanding or unpresented checks. Revising again, what is outstanding or unpresented checks? I have given someone the check, I have given them the check, I have paid them, and I have subtracted it from my cash book, but the bank hasn't done the same, so the bank is going to do the same. Suppose a check relating to a payment to a supplier of Poor Boy is written, signed and posted on 29 March. It is also entered in the cash book on the same day. By the time the supplier has received the check and paid it into his bank account, and by the time his bank has gone through the clearing system, the check does not appear in Poor Boy's statement until say 6th April. Poor Boy would regard the payment as being made on 29 March, and its cash book balance will be reflecting the true position at the date. You got it? Outstanding deposits or lodgements. In a similar way, a trader may receive checks by post on 31st March, enter them in the cash book, and pay them into the bank on the same day. The checks may not appear on the bank statement until 2nd April. Again, the cash book would be regarded as showing the true position. Outstanding deposits are also known as outstanding lodgements. Outstanding lodgements or outstanding deposits is something which we have received. Okay. So this is the format of how we'll be going about with the questions. We have a cash book, and cash book usually has a debit balance. So we are on the debit side, we have a balance brought forward. That is the positive balance. If the cash book has a negative balance, we will show it on the credit side. That would be on the right side. Give me a second. Okay. So adjustments on both the sides. Whatever had to increase the cash would come on the left side, and whatever had to basically decrease the cash will come on the right side.